Hello, everybody, and welcome back to video 2 in chapter 3. Cabrera has 100,000 shares of common stock outstanding. This is the only stock outstanding, and it has no other equity invest instruments outstanding. It's required to present a basic per share amount of $1.64 on the face of the income statement. And that term basic is important because there's also a fully diluted earnings per share, which assumes that everything that is out there that could be converted into outstanding shares is. So it's a kind of pretend number. So the key one here is basic earnings per share. Okay. And in this case, it's $1.64. All right. So here's the second illustration. And it issues another 100,000 shares on July 1. And then the weighted average number of shares for the calendar year is going to be 150,000 shares as shown. So you can see how that was done. If that was the case, we'd take that 164,489 and divide it by 150,000 shares to get $1.10. Okay, so you'll remember that formula was net income minus preferred stock dividends divided by the weighted average outstanding shares. Okay, so here we go. Lancer reports net income of 350,000. It declares and pays preferred stock dividends of 50,000 for the year. The weighted average number of common shares during the year is 100,000. What's its earnings per share? And as it's shown right down here, we take the net income, back out the preferred stock dividends, divide through by the average number of common shares, weighted average number of common shares. So we get $3 that way. All right. So here is our income statement with that $1.64. There's no implication that one type of revenue or expense has priority over another. So expenses are expenses. Here we have some selling expenses, some admin expenses, some other kinds of items that are expenses. And so this is the single step income statement in this case. So we have all our revenues up here. You'll notice we've got our dividend revenue and our gains on the sale of equipments up with their total revenues. And down here, we have our expenses, starting with cost of goods sold and all the other expenses. And the net income is the same. It's just a little bit more abbreviated in its appearance. Single step income statement. Okay, so a review question. A separation of operating and non-operating activities of a company exists in A, both a multiple step and a single step income statement, B, a multiple step but not a single step income statement, C, a single step but not a multiple step income statement, and D, neither a single step nor a multiple step income statement. Give you a second to think about that. And the correct answer, of course, is answer bravo here. A multiple step does have a separation of operating and non-operating activities, whereas the single step does not. Okay. So let's put that into practice a little bit with this example here related to Shark Incorporated. And they gave you a bunch of information here, which includes a lot of income statement items. And assuming that the tax rate is 30% and the weighted average number of common shares outstanding is $100,000, prepare the following for the year ended December 31st, 2025. And here we have the multiple step and the single step. And so some of these are pretty obviously not on an income statement. Accounts receivable, for example, and retained earnings. Those are, and cash. Those are not, and accounts payable. Clearly, those are balance sheet items, so we're not going to find that on the income statement. But the rest we need to place in the income statement in the right spot. So if we do that, if you can see these small things, we're going to put our revenues up here, less this is going to be a multiple step, right? Less our sales discounts, sales returns, and allowances. We get net sales, back out cost of goods sold to get to gross profit. We have our operating expenses, which are selling and general and administrative. And then we have our other revenues and gains, 19,000, and other expenses and losses, 510,000. So our income before tax, 1,053,000. We back out our tax at 30%, and that gives us our net income of 737,100. We divide that by there's no preferred stock in this case, so we're going to divide that through by the common shares weighted average common shares outstanding, and that's $7.37. Now, when we do the single step, we have to move some of these items around a little bit. So we're going to put all our revenues up here. We had interest revenue and gains. Okay, so we call that a revenue. And then we have all of our expenses here. Same net income, same earnings per common share. So I think pretty straightforward. All right, unusual items and how do we account for them? The accounting profession requires that companies record most items, including unusual and infrequent ones, as part of net income. So sometimes the companies are required to highlight items in the income statement so that the users can better determine the long run earning power of the company. And we have two special items we're going to look at here: discontinued items or operations and other comprehensive income. This other comprehensive income, as you proceed in your accounting training, you'll find becomes more and more an important term that you want to be familiar with. Okay, so discontinued operations here. It occurs when two things happen. A company eliminates the results of operations of a component of the business, or number two here, the elimination of a component that represents a significant or strategic shift having a major effect on the company's operations and financial results. These amounts are reported, as it says here, net of tax. And what that means is that the tax on those items have been either subtracted or added back, as the case may be. So that's an after-tax reporting. Okay, let's look at an exercise here. Here's Multiplex Products, a highly diversified company. It decides to discontinue its electronics division. During the current year, it lost $300,000 net of tax, and Multiplex Products sold the division at the end of the year at a loss of $500,000, again net of tax. Multiplex determines that the electronic division's discontinuation meets the strategic shift criteria because the division is a major line of business. Its assets exceed 20% of Multiplex's total assets. Okay, for the current year, it reports income from continuing operations of $20 million. How would you advise Multiplex to report this discontinued operation in the income statement? Well, this is how we would do it. We would have our income from continuing operations here at 20 million. And then we have a category or a component called discontinued operations. And we have those these losses here. Loss from the operation of the discontinued electronics division, net of tax. But we also have the loss from the disposal of electronics division, net of tax. So in total, that's an $800,000 deduction from income from continuing operations. And finally, our net income of $19,200. Okay, and this shows how we would show that in an income statement in a little more depth. Here, you'll see the discontinued operations. We had some income here, but we also had a loss here. So the net after tax was a deduction of $36,000 from our income from continuing operations. So our net income was $240,000. So you can see the per share is reported from continuing operations here, but then we're going to subtract out the effect of the discontinued division and the discontinued division, net of tax again, and that gives us $2.40 of earnings per share. Okay, intra-period tax allocation. Here, there's an allocation of tax within a period. It helps users understand income taxes on the various components of net income. There is an intra-period tax allocation, and it's used for both income from continuing operations and discontinued operations. All right. So here is an example. Beasley Enterprises has income before income tax of $250,000, has a gain of $100,000 from a discontinued operation. So, assuming a 30% income tax rate, Beasley presents the following information on the income statement. Here's the income before income tax, here's our income tax, and here's our income from continuing operations. Now again, these are after-tax numbers, so I can subtract those from this after-tax number of $175,000. Here's our gain, less the applicable income tax, and our net is $70,000 gain. So we're going to add the little beauty to $175,000 to get $245,000. Okay. Now, if it's a loss, we would do it the same way. Except here's our loss. Here's the income tax reduction of $30,000, and that is a $70,000 loss. Now, you may say, wow, you lost $100,000. Why are you reporting $70,000? Well, that loss reduces my taxable income. So my true after-tax loss is $70,000. Okay. Now here, this probably is a good place for us to stop this video. And when we return, we'll take a look at this note disclosure. Until that time, bye for now.